Welcome, everybody. Thank you for giving up your precious time with your family and friends and joining us in part 4 of the Get It Done series. Hopefully, we'll make it worth your while by giving you some valuable information and tools to set you on your financial journey. Today, we'll be focusing on buying Australian property in 2022. And today's guest speaker is Joe Bell of Rent Buy. In today's agenda, I'll kick it off by giving a quick update on Australian mortgages, which I haven't done for a while, before handing it over to Joe, who will be covering all you need to know about purchasing in 2022. And then we'll end it off with some Q&A at the end. So again, please leave your questions in the section, the Q&A section, and we'll be sure to answer as many as possible. Also, this webinar, like our previous webinars, will be recorded and uploaded to YouTube for you to review and share with others that will find this useful. So for those that don't know me and haven't seen my face, which I'm sure you have, I thought I'll just give, as always, a quick background and information about myself. I was born and raised in Sydney, lived all over the place, started off at the Shire, and then the western suburbs, inner west, before being here at the Hills area in Dural. But obviously I reside in Hong Kong, and my plan is to get back to Hong Kong once things possible. My qualifications are there. People have told me to sort of share that. It's very self-explanatory, but I guess the one thing that sort of is different is my Sydney Uni diploma or Bachelor of Behavioral Health Science, where I majored in psychology and sociology. And I think that's been very helpful in helping understand customer behavior, and sometimes helping the customer understand their own behaviors when it comes to finance. Everything else is finance related. I've been in the industry for almost 20 years now. Hard to believe. And most of that was with Westpac. I was there for 15 years in retail, premium and private banking, super investment and insurances, business banking and foreign exchange. And the last 2 years of my Westpac tenure was Westpac sent me over to Westpac Hong Kong private bank as a private banker, helping Australians and Hong Kong locals with their Australian finances. And most people would know, and we still feel a pinch now. Back then, there was Royal Commission, lots of things happening in that space. And that's when Westpac and all the other major Australian banks in Hong Kong decide to close shop, which, looking back at it, very grateful that I got the opportunity to then start my own business as a mortgage broker in 2017. And I'm very proud to say that in 2022, we've grown our team to 5 strong, with Stephen Doe as my business development manager and my amazing customer associates. I'll give them a shout out, Catherine, Jaja, and Nika. These names you will come by when I look after you. And we've invested heavily on sort of IT and process improvements to take away a lot of the pain and hassles that go with borrowing. The pain and hassles are there for Australian residents, as well as especially expats living around the world on earning foreign income. Now, our approach at Jason Lam Finance, or I like to say JL Finance, I don't like saying my name too much, but clearly we specialize in helping Australian expats around the world, specifically Asia and Hong Kong, as well as locals in Asia with their Australian mortgage needs. Whilst that is our primary objective, we approach things very much from a private bank point of view, where we look at your finance holistically, and I partner with like-minded professionals to round out the services clients need on their financial journey, and hence why we're doing these sessions and why we got Joe today. The list of services, which is ever growing, so obviously Australian mortgages, property sourcing through buyer's agent like Joe. We also partner with foreign exchange and OFX, which will be our next webinar, so a little bit of a prelude to that. Investment insurance with our other partners, as well as Australian tax. So we work with a lot of professionals that have dual experience. So people that are from Australia and know the industry and business very well as those that have expat experience. So we're not here to hear me talk about me. So what people want to know is borrowing. And the main question I get is, how much can I borrow? After 4 years as a mortgage broker, as an expat mortgage broker, and 20 years in the industry, till this day, I can't tell people how much they can borrow just based on their income alone. So people will go, Jason, I earn this much, how much can I borrow? Australian borrowing is obviously a lot more complex than, say, it is in Hong Kong, where your income multiplied by usually 10, and that's your borrowing. So in today's lending conditions, it's still very turbulent. Things are constantly changing for expat. But what I can definitely say is that there are a lot more options today than there was 4 years ago. So when I first started, there were probably 2 or 3 lenders, non-traditional lenders, so interest rates 4, 5, 6% that were lending with no majors and no sort of second tier lenders. Today, we're working predominantly with second tier lenders, 1 or 2 of the big 4. So it's looking a lot better for expat. And then also in terms of how much you can borrow, I'll go through why I've listed these, because everybody's different, everybody's unique. Again, I've been doing this for a long time and it's never a one size fits all approach. So it really comes down to what the banks look at is your type of income. So are you self-employed or are you employee? They'll treat it differently. Unfortunately, self-employed is still a bit more difficult to lend to. It's not impossible, but it is a harder slog on that end. If you're salary employed, then we've got a lot more options out there. Obviously, if you're earning Hong Kong dollars, any foreign currency, banks will treat that differently to versus Australian income. And even at the very simplest approach is, and how banks lend is, what's your income versus your expenses, and the difference between that, the surplus, is what you use for your repayments, and that's what they look at. Now, the harder part is different banks shade or discount your income differently. So some of the big banks shade it by 40, 50%. So if you earn 100 grand, they only assume you earn 50. Then they apply tax. So some banks will apply Australian tax, so you can kiss another half of that goodbye. And then the lenders that I use, they will use Hong Kong or net tax of the country you earn income from. So generally speaking, there are a lot of better lenders out there than your top 4 or your big 4. And then also, how do they treat people? Expats usually have a salary and then makes up, there's housing allowance, living allowance, educational allowance for kids, all different types of payments, and banks treat these differently. So again, every client is different. Now, I put visa type in there because again, as expats would know, some Australians move around the world and then they marry a British, someone from Hong Kong, wherever it is. The nationality or the visa type of your partner also contributes to how much we can borrow or use. So an example of that would be if both earn income and a partner is not Australian, that the banks some banks won't accept the non-Australian's income, but will accept the whole family's expenses. So there are nuances like that that we need to be wary of. And our job in my team will look for solutions and opportunities for our clients. And sometimes it's a matter of preparing and getting ready and knowing where you stand. And then ultimately is understanding, is borrowing even an option? So if it's not, then what are the next steps on your journey? So do we invest with financial advisors, do I cash? So we had that conversation about your overall. So other things to know and to consider is, and the number one rule for me, and I think most agents, seller or buyer, is getting your approval first. And I say this because something that I see quite often now is people getting disappointed because they'll go out after a conversation or they'll spend a lot of time and energy looking for their perfect place and dream place. And then they try to negotiate and then realize that the finance is not ready or can't be ready because the approval process can take some time. To save disappointment, get your pre-approval organized and then start looking. And also, my experience is that there's always a property out there for the buyer. So get the pre-approval first. The other part of getting the pre-approval and potentially avoiding being disappointed is that a lot of people, once they can't get finance because they missed out on their property, they give up because they've spent all this energy looking for a place and then they can't, or they fall short. Again, a lot of that psychological element to that. And then the last thing about the approval and getting your finance ready is that it helps you negotiate. So once you have your pre-approval, Joe can basically go in and say, finance is ready, we're good to go. And then you can negotiate pretty hard and quick and move very quick on that. The second point is, what are your priorities? So something I spend a lot of time talking to clients about is setting your priorities and understanding why you're doing what you're doing. Are you buying to live or buying to invest? And you need to make this very clear. It's because buying a property to live in is an emotional buy, and it doesn't necessarily make for good investment. And buying for investment that you may move back to live in and then may invest again. Again, best investments are possibly not where we know or where we grew up. So I tell clients to be very clear on that. Other priorities interest rates, so cheapest interest rates versus maximum borrowing. So I've got, obviously we want competitive rates, but for me, I tell clients the best thing to do is probably maximize your borrowing, because a bank that lends more takes on a bit more risk, hence the the interest rates is a little bit higher. But if that means you can borrow 200 grand, 500 grand, in some cases $1 million more, but pay 0.5% more interest, that means you can, one, move into a bigger, better house that you want to live in, or get a better quality of property asset. And along those lines as well, I say to people is be efficient with your cash and focus on flexibility. People are in Asia, in low tax countries for financial benefit. Throwing larger sums of cash down as deposit to save interest sounds good in theory, but if you need that money for emergencies later and you need to draw out cash, some lenders don't allow cash out, so they don't allow you to take money out. And if they do, I'm pretty sure from my experience that it might not be so easy to take that money out. And then having the flexibility of maximizing your borrowing, you can put your cash into the offset account to save yourself, or effectively have the same interest paid as you would if you put the cash down, but then you can use the cash whenever you need to. And on top of that, you put your cash, if you're putting money in the offset and you're saving 3%, and potentially paying and reducing your tax deductions in Australia, could that money be better off invested with, say, a financial advisor, or do it yourself and pay? And specifically Hong Kong, you pay no capital gains tax, you pay no income tax on your investment. So is your money better, one, being flexible and you can use as you need to, or two, doing more for you in Hong Kong and Asia? Obviously, you need to seek tax advice, and we've done a webinar previously on that, which you can have a look at and I can connect you to. But these are things just to consider. The few other tips is, minimize your credit cards and personal loans. Banks look at this as part of your overall debt. I think most people know that by now. The other tip that I always tell people is to stop putting group dinners on your credit card and then everyone paying you. The banks will look at this as your lifestyle expense. So although we could explain away and mitigate this to the lender, for me, it's better to not even raise that to the lender to get your credit through. The last thing is expense declaration. So something that I tell people is, especially with me, you can tell me and disclose to me your expenses and what's going on, because then I can give advice on what we need to do. Do we need to wait a while, clean up transactions and so on, or are things okay? So a lot of people think that because they splurged, because for a while there was a lot of staycations or a lot of luxury buying, because a lot of Australians found it difficult to borrow or do anything, so they spend the hard-earned money. These are explainable, so they're fine. As well as if you move and you've got to refurbish your house, we can explain that away. Things that we can't explain away and we need to clean up and get the behaviors is things like gambling, any money that's going regularly elsewhere. We need to clean that up to paint a better picture when we go to the lender. And our job really is to explain your situation to the lender and make them comfortable to lend to you. So being upfront and honest is the best policy, I believe, because if we're not and the banks sniff a little bit or they start asking questions, it's often quite hard to get them back on side, because they'll forever look at that lens with questionable colors. So that's all for me for now. Thank you on my part. I tried to keep it as short as possible. But before we go over to Joe, the reason we created this Get It Done series is because from my experience, a lot of our customers need help with their financial journey. And I've seen people come to me and start the approval process only to see them back 1 or 2 years later and they're still out of the market. Now, we know that generally speaking, property prices last year went up 20-30% depending on areas. And this year it's estimated for another 10-20%. And I'll leave a lot of this for Joe to cover. But what I will say is that most people's income do not go up with this trend. I don't see many people's income go up 20, 30, 10%. What this means is a lot of people are being priced out or overpaid in areas that they want to buy 1 or 2 years ago. And the reason for that is a lot of people think that they can do it themselves and that it can save money and to pay for professionals. But to save 2% or 1% or whatever it may be, they end up chasing 10, 20 30% returns. And this is the whole reason why I'm putting professionals together for the community to hopefully help you get to where you need to be. Because even the most experienced property investors with 6 or 7 properties, to me, is no match for a buyer's agent who, if they buy one a month, is still very experienced and the tricks of the trade. So on that note, I'm excited to finally introduce Joe Bell, buyer's agent and founder of Rent, Buy, Move, because as you can see, I'm a massive advocate for buyer's agent because I represent the buyer as well. And hopefully after this presentation, you'll see the value of using a buyer's agent too. So whilst Joe jumps on and shares her screen, I'll just remind everybody to put your questions in the Q&A section. There's a Q&A box that you can click on, and we'll do our best to answer that at the end. So as Joe is doing that, I'll pass it over to Joe. Just a second. Joe, you've got yourself on mute.
All right, how's that? We back?
Perfect.
Lovely.
Okay, I'll leave it to you. Thank you, Joe.
Thank you. Hi, everyone. Thank you for joining us this evening. My name's Joe Bell. I'm the founder of Rent, Buy, Move. I'm a real estate agent licensed in Australia, a registered auctioneer and a qualified valuer. This evening, I'm going to speak about Australian property purchasing, where we're sitting currently with the market, what that means generally in terms of is now the right to buy, the time is right to buy, and whether or not you should hold. We will also talk about the sustainability of what's happening in regional Australia. But before I start, a little bit about me. My background has been many years in the building industry and property market. It started back when I was 19. I invested in property very early on, and I found that path to wealth to be a very exciting and rewarding one. My job today is helping people realize the same success, and that gives me great pleasure. After working in corporate Australia for more than 25 years, in 2019, I made the bold and brave decision to go out on my own and start an agency focused on working with buyers. It's an unusual space for the Australian real estate land. We've had many years of working with selling agents, but not so much experience working with buyers agents. And many of us and many of my clients in the initial discussion find it difficult to navigate understanding what a buyer's agent might bring to the table. So I hope after tonight's discussion, I'm able to share enough information with you for you to realise the benefit of working with a buyer's agent. Or if you still decide to go it alone, hopefully I've given you some tips that help you along the way. I moved to Hong Kong in 2019. And I've been domiciled here in Hong Kong for the last 3 years in really interesting times. But my client base is focused largely on Australian expats based in Hong Kong looking to buy either a return home or to provide themselves with an opportunity in a property portfolio to drive some passive income while picking up great capital gains. So depending on what my clients' needs are out of Hong Kong, I spend a lot of time analysing the market and using the data that I subscribe to make sure we make very good decisions. I also have equally a good client base down in Australia, and currently I'm working with several clients that are looking at moves either regionally or interstate. So it doesn't really matter what the territory is. I buy in Adelaide, Sydney, Melbourne and Brisbane, and I buy in the regional areas surrounding all of those capital cities. So let's get started and I'll talk you through what's happening in the Australian property market. So residential real estate underpins Australia's wealth. Currently, we're sitting with $9.7 trillion invested in real estate. The interesting factor of this particular data set is that 70% of owner-occupiers sit within that financial investment pool. We are lean on having rental properties. So I'm going to talk more about the rental property opportunity. 2 trillion of that money invested is in outstanding mortgage debt. Now we know that in the next 2 years, we have 500 million of outstanding mortgage debt in fixed rate mortgages due to mature. When that happens, we'll see interest rates for that group doubling and probably even above doubling. So there could be some opportunities in some stress mortgage, stress real estate, but let's keep a watch on that space. As you can see here on the left side of the screen, we have 3.4 trillion invested in Australian super, 3 in Australian stocks, and 1.1 trillion in commercial real estate. Overarchingly, a heavily invested, some 55.6% of household wealth sits in their housing, and they're going to rely heavily on that during and into their retirement. This screen is something that I've used a couple of times in the last 12 months. And so anyone here that's on this webinar that's listened to me speak before will be familiar with it. The red box to the right is indicating what was forecast by Westpac Economics together with CoreLogic back in 2020. The big question was, in leading into the pandemic, what is going to happen with the Australian market? So the forecast for growth across Australia for 2021 sat at 10%. Now we understand that actually realised out to be above 20%. My estimates for 2022 sit largely above that 10% that you can see in the far right of the screen. I'm estimating we're going to see continued growth north of 15% across Australia. And I think we'll see above 20% still in some of those regional pockets, and certainly in Brisbane. And we're going to discuss a little bit more about why I feel that way. So let's get into some data very quickly. I won't labour on too many of these screens because I don't want to get too bogged down. But the Australian dwelling values in the 3 months to January still grew at 3.4%. Now, it wasn't as high as the peak that we saw in the 3 months leading into May 2021. However, at 3.4% growth, you can still get a sense we still have outstanding growth happening right now. In the 12 months to January, we saw dwelling values across Australia grow at 22.4%. Now that starts a new cyclical high. I think the last 2 years has been all about records being broken, and we are still in the space of breaking records, which is phenomenal and hard to understand why, but we'll talk about that a little bit more later. In the capital cities, I think this is a really important change. Last year, the capital cities were looking at the strongest growth segment with what I call the prestige market. That is the top 25% of the value group. Now, what's happened leading into 2022 in January, we're seeing a switch on that. So values in the top 25% or the prestige market grew at 1.9%, compared with a 3.5% growth of the lowest 25% of values. So we're seeing the bottom end of the market flipping, growing faster now than the top end of the market, which is very interesting. Sorry. Beg your pardon, I hit too many clicks there. Okay, so my apologies. Capital city growth in this bar chart, again, the dark purple indicates the top 25% of the market value. The lilac, or the very light purple, is the middle 50% values, and the purple is the bottom end of values, so 25%. So we're talking in thirds here. You'll see in Brisbane, we almost have all 3 segments firing at once, and Brisbane is an anomaly. If we look to the right of the Brisbane set, over here, we're talking about Adelaide, and Adelaide is still leading at their prestige level. However, their middle section and their bottom section is definitely catching up. So I'm not sure where we're going to see, Nostradamus couldn't predict it. I'm not sure where we're going to see that flip over, but we are certainly seeing some change happening in Adelaide. These 2 capital cities are still significantly below the property mediums of the other 2 major cities, being Melbourne and Sydney. As we look across the screen, we go to Darwin and we see that the prestige market is actually in negative territory. In ACT, the bottom end of the market is leading. And then if we come across here to Melbourne, we're seeing prestige market has definitely come off, although it's grown 0.1%, while we're looking at the middle leading the market and the bottom end of the price range coming along quite nicely. Okay, moving on to 12-month changes. So in Australia, up to January 30 of this year, we've seen a 22.4% growth. Now, interestingly, 26.1% of growth has come from the combined regionals. I'm not sure if many of you are across what's happening in media and the commentary, but commentators in Australia are suggesting that the combined regional growth will stop, and that it's not sustainable and that it's being driven by the factor of COVID. Now, we'll talk a little bit more about that in the next few slides, but I don't agree with that commentary, and I've got some data here which will suggest otherwise. Totally, the combined capitals grew at 21.3. It's still an outstanding growth, but again, we're seeing a flip of which segments are growing at a higher rate. National sales. So with our sales volumes, I watch this metric really carefully, and I watch it because it gives me an indication of what's happening in terms of price direction. So if sales volumes increase, we know that price direction is trending up. If sales volumes decrease, obviously it's trending down. So the correlation here fits beautifully. We're seeing sales volumes in this section to the 12 months of January to January 30, 2022, growing at 41.6%. It's phenomenal. The combined regional area at 37.4, and then the combined capitals at 44.3. Moving on from here. The 3-month changes on Australia. Sorry, I think I've gone backwards. Apologies, I'm having a bit of a problem here. Sorry, 3 months changes. So the change in dwelling values, 3 months to January 2022. Across Australia, just in January, the 3-month quarter, so we're going November, December, January, we saw an increase in value of 3.4. In the combined regional areas, we saw an increased value of 6.3. The capitals grew at 2.6. Now, if we look into this section here, what we're looking at is Brisbane and Adelaide, outstanding performers, doing incredibly well at 8.3 and 7.4 respectively. These two major cities have been on a growth trajectory now for more than 10 years. And whilst there's been early signs of quite modest increase, what we have seen over the last 5 years is a significant uplift in value. And that's largely due to the affordability aspect. Total number of listings, we've got still some listing issues. So supply and demand, what we're talking about here, total listings over the 4 weeks to the end of January. So all stock on market, 121,909 homes. That is still 20% below the same time last year and 36.9% compared to the 5-year average. If we don't have enough stock on market and we've got a lot of people out buying, then the power distribution is firmly sitting in the hands of the seller. What further adds to frustration in this space is that in the January month of all total listings, only 33,160 new listings came onto market. So whilst that is a marginal increase of 5.7% on the same time last year, it is still 7% below the 5-year average. So this is what is driving demand in the Australian market, and will continue to do so while new listings are lean coming through. When we look at median days on market, we're not seeing any major changes here. 7 days as opposed to, in the regional locations. When we look at combined capitals, we're looking at 5 days. So it's pretty much line ball on where we were same time last year. Vendor discounting, gone are the days where we used to be able to expect to see reasonable negotiation on property, sadly. That's basically a combined reasoning because we've got low stock levels, we have reasonably low interest rates, although there's some minor changes happening there. We also have a significant issue in terms of what's happening in the auction space. So auctions commenced in Victoria. That was the strongest state for auctions. Sydney took the auction method of sale up, and then Brisbane was late to the party. But in this particular market, what we're seeing is many more homes being sold at auction, and the ability to be able to discount or buy property well is hampered by the auction environment. As a buyer's agent, I spend a lot of time working with clients trying to get them the best deal. When I founded Buy Smart Property, which was the first business I commenced in Australia, the ethos of that business was that profit is realised at purchase, not at sale. So at the moment, we have to think on our feet as buyers agents, how do we capture property for clients at a reasonable price and even at value in a market that's growing in terms of price growth at these sorts of rates? It's quite complex and quite difficult. So today I will give you some insight on how I go about that. Weekly clearance rates. So if we're looking at the overall combined result for January on auction clearance rates, it's 69.6%. So if we have a look here, you'll see dips and troughs. I won't go into the detail of that too much, but 69.6% across Australia is a phenomenal rate of auction clearance. Working in the state of Queensland and in the city of Brisbane at the moment, I have several buyers looking to buy property there. In the past, I would find listings more attuned to an offer before auction. So I've got to get my timing almost perfect so that it's in the middle of the campaign to get people to consider my offer. More and more people in Brisbane, particularly because their market is growing at such a fast rate, are erring towards the auction environment over private treaty. I want to talk a little bit about rental rates. So I hope online we might have some people here that are interested in rental property and rental yields. As we do, when prices increase in the market, we see a significant shift in what rent values move to. Here in Australia at the moment, we're seeing a 9% increase in rent values to the 12 months to November. It's a significant change, and we're seeing even larger changes in the regions. So currently the regional combined rental rate increase is at 11.5%, and capital cities are growing at 8.1%. Now this is total property, this is house and apartments. Now what's the impact of that on yields? It's not great. As rental prices go up and as purchase prices increase or property value increases, rental yields come down momentarily until they get time to catch up. So across Australia, our average yield is 3.2%. The regions are higher at 4.1%, and the combined capitals are sitting at 3%. We will see the lag catch up, but I imagine it's going to be probably 2 to 3 years before we see that catch up due to lease durations. And the combined regionals, if you've been across what's happening in Australia recently, particularly in the last week, we've seen horrific flooding. So certainly this is going to have an impact to a degree on values and on rents. So let's just keep watching that space and see how that pans out. Is what we're seeing sustainable or not? Is the $64 million question. Watching commentary daily, and I'm seeing reporters talking about the lack of sustainability and what's happening in the regional aspects of Australia. I disagree firmly with what they're alluding to. The exodus into the regions is driven mostly, and number one main driver is for affordable living. The prices that sit with the hill change towns and the sea-clave locations is still well below the prices of capital cities. So this trend has been going. If we look at price growth and if we look at migration, there's been this consistent up curve for the last 10 years in property price and migration to regional Australia. What has helped it along is the advancement in technology, and yes, the pandemic has certainly given it a turbocharge. But at the same time, the enforced lockdowns and companies being more comfortable with their staff working from home has meant that people have been able to go confidently into the regions and look to setting their lives up long term in those locations. The impact of infrastructure has also had a very big bang to regional relocation. We are seeing billions of dollars being rolled out in projects across regional Australia, New South Wales, the far north Queensland location, mid-Queensland, regional Queensland. And they largely sit around things like, transport infrastructure, medical provision, education, and the quality of life within those regions. So river projects, airport upgrade, roads in and out, and transport links and connections. And then just the standard beautification of each of those locations. Low vacancy rates has been a massive impact on people moving and people investing. And we're seeing largely across these regional locations below 1% interest rates, which is phenomenal. Vacancy rates, my apologies. Low stock levels are driving demand. Low interest rates from banks have certainly been a big plus. Many people in the capital cities have gained great equity in their homes, and this is an opportunity for them to downsize, move into something more affordable, put some money away. And I'm working quite hard with clients who are in this space who are looking to build their property portfolio for passive income. So I'm doing a lot of work with investors while at the same time working with expats here in Hong Kong to find their forever homes. Upgrading and improving is another major aspect to people's decision making in terms of moving into regional locations. They have needs. People have been working from home. They need better office areas. They need more zones within their home for relaxation and work. They're more prescribed when I do sit down with people and do briefs. They're much more prescribed around the aspect of how the living location needs to be laid out. Floor plan now has been more important than ever with my buyers, and it's all relating to upgrading and improving the way in which they're living. Okay, moving on. So what's hot right now? If you were to say to me, Joe, I want to invest in something right now, where should I do that and why should I do that? Brisbane and Southeast Queensland is being driven for, I guess the migration to Queensland is driven across a few factors. The first one is climate and lifestyle, along with affordability. So even though we've seen massive increases above 30% in a lot of these pockets in the last 12 months, we are still significantly below a 4-bedroom home in Sydney or in Melbourne. If we have a look at what's happening in terms of infrastructure, it's all set around the 2032 Olympic Games. Now, obviously infrastructure, I'm a big believer in following infrastructure. It brings obviously great job situation, but improved living conditions. So with the Olympics, we've got lots of venues that need to be built. We have lots of links and transport, and we know that the quality of life and lifestyle improves significantly once we've seen an Olympic or a major event held in a city. So I estimate that Sydney, Brisbane and Southeast Queensland will continue to grow in value above the other states for the next period through to 2032. Mid-North Queensland is certainly driving and growing at a rate beyond a lot of the major capitals because of the same factors. When I talk about Mid-North Coast Queensland, I'm talking about that area above from anywhere from Hervey Bay North, and certainly we'll talk more closely around areas specifically in that section. Northern Rivers, New South Wales is an interesting one. I'd say if we were talking a week ago, I'd be discussing Northern Rivers growth at 39% in the last 12 months. However, the floods have had a massive impact, and we've seen flood height peaking at 4.4 metres in Lismore. I'm a big fan of Lismore. I think Lismore's got some great advantages, but until they get the river system fixed, I think that's going to be a problem for growth from now until people's memories forget. Toowoomba is a major inland city. Toowoomba has seen big infrastructure projects, particularly airport, health and education. I'm looking at growth patterns over the last 12 months in Toowoomba, and from the last 12 months to the end of January, I'm noting growth above 30%. Rockhampton's a great city. It didn't get impacted by floods at this round. It is a river city, and there are projects going on there right now which will improve the Fitzroy River Weir, along with education and health. It's our beef capital in Australia. It's a great logistics location. It has an airport. It has great education. It's about 25 minutes drive to the coast, and that coastal area is a place called Yeppoon. Yeppoon, in my view, is the last spot of the east coast of Australia where there's an opportunity to have beachfront homes that will grow into a hamlet similar to Noosa in the future. So that's another one I'm giving away for free today. That is my pick, but you have to be very careful on these locations where you're investing and how much you're spending and what type of property you're buying. And that's where having my expertise or the expertise of a buyer's agent who's familiar with these locations guiding you. I want to talk quickly about boutique apartments in city fringe locations. I did some analysis recently between Paddington in Sydney and Fitzroy in Melbourne. Both locations are the same distance from the city CBD. They have a very similar demographic profile and a population base almost the same. When I look at house price differences to unit price differences in Paddington, and I do the same view in Fitzroy, the gap between the two cities is roughly 10%. I see that there's an opportunity in locations set close to city within 6 to 8 kilometres in boutique apartment buildings Not large buildings, but buildings with some unique features. I see real opportunity and great growth. They're spattered around. You have to be very careful. You've got to know exactly what you're looking for. But this is an opportunity that is coming into the next 5 years where investment returns are going to be quite significant. Following infrastructure, we talked about that a little bit. I'm a big fan of infrastructure being a leader when you're looking to invest your money. Whether you're buying for yield and return or you're buying to live in your property, it is an investment, any way you look at it. So we have to make sure when you're buying a property, you're not overspending, you're buying in the right location, you're buying for the right reasons, and you're getting the right property at the right price. So why a buyer's agent? Why would you work with me? Besides the fact that I'm a pretty decent down-to-earth person, my knowledge in terms of where to buy, how to buy, what price to buy at, isn't stuck to just one location. If I was domiciled in Australia, I'd be forced to be working in territories, and my view would not be anywhere near as developed and extensive as it is with me based here in Hong Kong. I spend every day analysing data, looking at what's happening in terms of sales volumes, auction clearance and price direction, and then I'm sanity checking that back in with my expert down in Australia who's been doing property forecasting and research for the last 35 years. So when I think I'm onto something, I'm pretty confident, but I always make sure I check in with people that have been doing it longer than me. As a consequence to that, I want to share with you some recent case studies to give you a feel of what I do, how I go about it, and what the benefits are. Okay, so here we're looking at a case study based in Bersika. Bersika is a suburb of Rockhampton, 640 kilometres north of Brisbane and 40 kilometres west of Yeppoon. Median house price is $220,000. Vacancy rates are sitting below 1%, and the one-year growth that I've charted updated as today is 11.2%. 3 billion in infrastructure projects currently, and approximately 34% of the population rent in Bersika. I purchased back on the 24th of September for a client. This was the second assignment the same client gave me. The first one I bought for him in Northcote, actually in Melbourne. This one, he was after an investment property and he wanted something that he could take a bit of a risk on. So we found a 4-bedroom, 2-bathroom, 2-car parking property, approximately 118 square metres internal, on an 810 square metre flat block of land out of any flood conditions. We purchased on the 24th of September in 2021 and we paid $360,000 for the home. The estimated value today when I checked is $388,000. It's rented for $560 a week, getting an 8%, little over 8% yield. The buyer's agent fee, my fee for this assignment was $7,200. Moving on, case study in East Toowoomba is a suburb of Toowoomba, Queensland, 130 kilometres west of Brisbane. Median house price is $680,000, vacancy rates are 0.5%. One-year growth, 27.9%. 10-year growth, 91.4%, with 28 billion in infrastructure projects underway in Toowoomba currently, and there are approximately 37% of the population are renting. I purchased a 3-bedroom, 1-bathroom, 2-car parking property, approximately 120 square metres in size, on a 900 square metre block of land. It was purchased on the 22nd of September 2021 and we paid $765,000. Estimated value as at today is $945,000. It's rented at $735 a week. We're getting 4.9% yield. My fee was $15,300. This particular assignment was not wholly for an investment. When my client repatriates from Hong Kong, they're going to move back into this home and they plan extensive renovations. They want to keep the home in its heritage state, but they needed lots of land to do the work that they're looking to do. So that was a phenomenal outcome. And the growth they've experienced since is quite substantial, as you can see. The gap in Queensland, this was a lovely assignment. I have a beautiful couple here in Hong Kong with 3 gorgeous kids, been here 17 years and had invested in Australia in Queensland previously, bought from Hong Kong through an agency here in Hong Kong. They bought off plan and they weren't experiencing very good success with these properties, a townhouse and an apartment. When we met, we talked about both properties and we looked at what the value of the properties were, given that they've been held for 16 years. I'm sad to say that my clients sold their townhouse below the cost of what they paid for it 16 years earlier. And the apartment that they purchased in South Brisbane, they ended up hanging on to because it made no sense to sell it. They couldn't even achieve the entry price. This is a perfect example of how things go horribly wrong when you're not working with people that are giving you advice without their own agenda. So for this couple, we sold the townhouse, we got out of that. We were looking at locations around the Brisbane River, but not in the flood zone. And we wanted to be in a certain catchment areas that gave my clients really good access to great schools. The frustrating aspect of this was that we were working on a budget of 1.2 million. And on that budget, everything was going to auction in the locations we were looking at. We just couldn't get there. Everything would end up selling at 1.3, 1.35, 1.4. My clients were getting fatigued with the disappointment. So I sat down and made some analysis of where I thought the next opportunity location was, and I picked the Gap for them. So it's what I call a filter suburb. It's that suburb that's moving out from where the action is, but in time, short time, the direction of people's interest would go there because the areas that we're looking at become unaffordable, and that's exactly what's happened. So the Gap is a suburb situated 10 kilometres northwest of Brisbane CBD. Currently, the median house price is $1,070,000. At the time we bought this home, the median price was $950,000. We purchased a 4-bedroom house, 2 bathrooms with 2 car parking, 316 square metre internal space. It's a beautiful, large, very well laid out property. It's on a reasonably it's not a big block, it's 554 square metres. We purchased in July 2021 and we purchased off auction. So it was private treaty, although it was an auction campaign. We paid $1,110,000 and its estimated value today is 1.55. So that's a phenomenal growth in a very short period of time. It's rented at $885 per week. So they're currently getting a yield of 4%. My fee was $22,200 on this one. But as you can see, we've more than made sense of that with what the growth we've achieved. Now, this client was looking to repatriate back to Australia in 4 to 5 years when we engaged back in April, May last year. With what's happening in Hong Kong, they've made decisions now to return in this summer, and they're going back to a home that is ready for them, hasn't been rented beyond one current tenant, and they'll be able to move in and understand and enjoy the fact that they've picked something up that's now some $400,000 above what they paid for. Over here to the right, what we've got in terms of this particular area, the big hurdle was Waterworks Road, which is the access road in and out of the Gap. Waterworks Road is undergoing massive upgrades, and that's going to make travelling in and out of the suburb a dream, and that's reflecting in the growth that we're seeing. Case study, Gerard's Hill. This is a really hard one for me because this is situated in the Lismore location, which has experienced phenomenal floods. So Gerard's Hill is a suburb of Lismore, New South Wales, 735 kilometres north of Sydney, 35 kilometres west of Ballina, another location which has significantly been impacted by the floods. Median house price is $544,000. Vacancy rates are below 1%. In the 1 year to the floods, we were enjoying, or this particular location was enjoying, a 33.1% growth in house prices. Over 10 years, it's grown above 100%, which is amazing. This particular area offers hill and tree change lifestyle features. There's also been massive upgrades in medical and education. So it's now known as a hub to that surrounding area. Approximately 40% of the population are renters. So we bought a 2x2 bedroom, 2 bathroom. Basically, it's a duplex. It's 160 square metres internally on a 550 square metre block of land. It was bought in August 2021 for $675,000. The estimated value today is $780,000. It's rented at $832 a week, and the yield is 6.4%. My fee was $13,500. On this particular one, we've got long-term renters. So this was purchased with tenants in situ, and these tenants are planning to stay. There's been no disruption for them. In this location with a 40% population renting, they don't like to move when they're in, and they're in both units. There are elderly couples. I'm going to sit back with a great deal of interest and sympathy and empathy for the people of this location. They've been inundated with floods, and I really hope that the area rebounds well. A little bit about my process. This is my model. Everyone has a different model to a degree, but basically I start with a free consultation where I meet my clients and we make a decision about whether or not the vibe is right, we can work together, whether or not I can satisfy the expectations. It's really important for me to understand what my client expectation is up front. I very quickly send them off an agreement and we get a brief. The brief is really important. I do my research based on the brief, I do my due diligence, and then I provide a shortlist. I have people on the ground down in Australia, so we get to site visits as quickly as we can, and wherever I can, I try and do site visits outside of the regular mass hordes going through homes. In the negotiation phase, there's a couple of things I'd like to say here. In reference to Jason's earlier points around pre-approval, in this market, if you are not pre-approved, you're not going to auction because there are no conditions at an auction sale. At auction, as soon as the hammer goes down, you are unconditional. So if your finance isn't approved and it doesn't become approved, you are then up for significant damages to be paid to the vendor because you can't complete the purchase. So outside of that situation, if we're going private treaty and we're making an offer, and you don't have finance approved and we need to put it in as a condition, you're not going to get ahead of people who are offering less with no conditions. So it's really important to have your pre-approval already lined up. I'll also say in most cases, pre-approvals are 3 months. And I've had a couple of my clients recently say to me, oh my goodness, the process to get approval is so arduous that if I can't find something in 3 months, I couldn't possibly go through that again. Well, actually, it's much easier the second time. So if you're extending your pre-approval, it's a much more simple process, and I'm sure Jason can talk more specifically about that. But it is an absolute must-have before we start putting offers forward. Once I've negotiated, we go to contract. I manage the handover. And if you're living outside of Australia and you're a client of mine, I also provide for you at no extra charge international support to relocate you back to Australia. I'm just going to spend a couple of minutes talking about 2 or 3 historic assignments where I would like to demonstrate to you what's happened 12 and 18 months on. This historic assignment was a case study. It was a really interesting assignment. My client was a woman over 50. She was from Perth, but she was living in Melbourne because of work. She was out of the property market. She was in a rental and she had to be out of the rental in 4 weeks. When I met her, she didn't have finance approval and she was on a really tight budget. She actually said to me, I need you to buy me a house for $500,000. So the first thing I needed to do with her was get her finance approved, and I introduced her to a broker of mine down in Australia before I met Jason, and we worked very quickly to get her finance approved. At the same time, I started searching once she'd given me a very good brief. I found a house for her in Frankston, Victoria. She wanted something that was going to be a growth location that gave her a nice lifestyle and gave her access back into Melbourne CBD, which is where her office was. The house that I found had 54 groups through, 13 offers I was up against, and we were the 3rd highest offer in price that we put forward. After carefully negotiating and no conditions with a 2-day cooling off, I quickly moved in the cooling off period to get pest and building inspections done and a conveyance check. Now, the benefit here was we were finance pre-approved and no conditions, not even for the pest and building. And so they accepted our offer, which was the 3rd highest, not the highest, because the 2 above us were conditional. In the phase of getting the pest and building inspection done, we identified a roof issue, which I was aware was there. I renegotiated a further $10,000 off the buy price. So my result here was property purchased at $570,000. We're talking 3 beds, 2 bathrooms, double garage on 800 square meters, instead of the top offer of $585. We saved $15,000 there. We saved $3,000 on the conveyancing by introducing her to my network in Melbourne. We saved $250,000 on the building, sorry, $250 on the building and pest. And my buyer's fee for this exchange was $11,400. My client's home today is worth $667,000. The second case study I want to talk to you about is Prospect Adelaide. This is a high-profile athlete who has moved from the Illawarra into Adelaide to take up a position with a high-profile sporting team. He and his partner needed to buy under the government incentive, which was the buy build government grant. And they also needed to take advantage of the first home buyers grant. So there's a couple of government incentives rolling. I was on really short time. These government incentives were due to fall a deadline 6 weeks out. And I was working really hard here to get this across the line. We bought a property under construction. It was a 3-bedroom plus a study, so essentially a 4-bedroom property, 2.5 bathrooms. It's a Torrens titled townhome. We paid $565,000 for this property. It's situated in a managed estate with very low holding costs, only 4 kilometres out from the CBD. We exchanged contracts before the government grant cut-off, so they received they received all of their grants, which was $30,000 collectively. I negotiated $18,000 worth of extras for them internally, and that consisted of floor coverings, window coverings, light fittings, additional air conditioning. The purchase price, as I said, was $565,000. My fee was $11,300, and the value of the property today, 12 months on, is $735,000. So why would you buy property now, and why would you buy property using a buyer's agent? The property market of Australia is hotly contested with really low stock levels and lots of people out hunting. It has been a very challenging market for the last couple of years, and that hasn't changed. You need all the support you can garner with people who have got good knowledge and understand value so that they're protecting you on overpaying. The Australian property market will continue to grow between 10 and 15% over the next 12 months. And in some pockets, actually, I'm seeing closer to 20. So if you think holding is going to change something, it's not, because if you're here next year, we're going to be talking about what the year was and how those growth patterns look. High growth will definitely occur in the regional area and pockets. I'm convinced that the sustainability of the moving out to the regions is definitely going to continue. We have still very affordable housing and lifestyle benefits there. Infrastructure positively impacts housing values in regional Australia. So if you're an investor, give me a call. Let's talk about what your options are here, because now's the time to purchase in these locations. They're not going to stay at the price that they're at today. They will continue to grow, and I feel they're going to continue to grow above 20-25%. APRA, a governing body that presides over our finance behaviour, will make further changes in rising interest rates. There's a lot of discussion around that at the moment, and I think it's fear-mongering. I don't see any significant changes in interest rates this year. I see maybe 0.5% to 1%. The bigger issue is the maturing fixed debt, 500 million. And when that comes off, I think those people are going to be in for some tough times. There will certainly be a portion of people in that group that have over-leveraged. Big cities will continue to grow, albeit at a slower pace, but there's still opportunities in places like Brisbane and Adelaide. And even in Sydney, I know that sounds weird, but there are pockets in Sydney that are still giving people with enough money to enter the market. Although you're entering at a higher rate, you will still see some good growth there. New listing levels have improved marginally, and this does help us when we're searching. It means that our search times are a little bit less, but it's still challenging. The gap between house and unit values provides real opportunities. So if you're somebody with an appetite to dive into a unit purchase and you need some support, I'm across this space and I can certainly help you buy well here. Thank you for your time. It's been a pleasure to present to you this evening. I hope some of this has been helpful. If you do decide to purchase property without the assistance of a buyer's agent, maybe some of my content tonight has been helpful to assist you in that space, but certainly I'm here to help you, and I look forward to answering any questions that you might have. Over to you, Jason.
Thank you very much. Thank you very much, Jo. Very insightful, and I think it's great to see all the case studies. I think a lot of people might not have seen that or seen it from a buyer's agent perspective, and definitely visualizes what a buyer's agent does. So we do have a few questions coming through. So again, if you've got any questions, put it in the Q&A box and we'll get to it. Let me just go through it now. First up, buyer's agent fees deductible. That'll be for you, Joe.
Okay, so when we say buyer's agent fees deductible, I'm not really sure of what that means. Does that mean, is the buyer's fee negotiable? It certainly is to a degree, but the value of what you're getting in return for your investment, as we've seen demonstrated this evening, is significant. It's also, shall I say, buyer's fees are, when you're buying an investment property, they're fully tax deductible. So if we're looking at what the fee structure is, when you look to your capital gains on selling, or your returns when you're looking at paying tax on your return, your entry prices to buy that property are 100% tax deductible.
Thank you for that. So I think you touched on it a little bit, but do all buyer's agents charge the same?
No, we have an industry standard. So industry standard rate is between 2 and 3%. So it's very similar to the selling agent environment. I tend to I offer 3 different groups of services. So I offer end-to-end, I offer shortlisting, and I offer negotiating as 3 separate services, and they have different fee structures. If I'm buying a property for somebody of a value above $3 million, my fee significantly reduces. Depending on your circumstances, the value of the property that you're buying, my fee is adjustable on that basis.
Okay. And along those lines, and I'll ask you this question because I get this quite a lot, is why would a client pay a buyer's agent fee and a selling fee?
Okay, it's an interesting question, Jason. I say this to people, a real estate selling agent, we are very comfortable using, but a lot of us don't realize we don't have to use a real estate selling agent, just like we don't have to use a buyer's agent. But we're so heavily conditioned to ringing up a real estate agent and saying, sell my house. At the end of the day, you're going to spend 2% of your sale price using an agent to sell your property, when in fact, in many respects, your property sells itself. So if you've got a great location, you've got a good block of land and it's well presented, all the agent's really doing is putting your ads that you're paying for onto realestate.com and Domain, and they're filtering and managing inquiry. As a buyer's agent, we're actually doing the hard yards. We're sitting down with you, we're understanding what your brief is, we're hunting in the market, we're covering you to make sure that you're not over-investing in the wrong area, we're negotiating for you to make sure you're not getting ripped off. We're actually doing a lot of work which isn't about you as the buyer. You're not funding it in any other section other than the service. So it's all about the expertise. You're paying for expertise, you're paying for time, and you're paying for the result. With a selling agent, you're paying basically for you're paying a commission, and then you're paying an advertising campaign, and your house is the reason why people are buying it. So in this market at the moment, I would say more people are comfortable using a selling agent than a buying agent, but now more than ever, they need a buying agent equally as much, if not more, than a selling agent.
Yeah, thank you for that. And I guess I'll add to that a little bit. From what I've seen is that a selling agent can really only sell what they've pigeonholed to. So you go to, I used to work with Ray White, so you go to Ray White, say Bondi, they can only really sell you what they've got. Whereas the buyer's agents that I work with, like Joe, they go out and look for what the client's after. And that brief is so important. And we tend to, as humans, we gravitate to what we're comfortable in. If you grow up in a certain area, people for investment purposes also go to that area, although the brief might allow them to look at other areas. So I think that's what the difference between, for me, buyers is different to a selling agent, is that you go out and look for what the client's after, not sell what you've got to sell. So I think that's really important. And another analogy that another buyer's agent have given me before is if, for example, if you have to go to court and you rock up by yourself, and when the other party has a lawyer, you got no chance. And in particular, you're paying for the other lawyer. To me, it's, again, I represent the buyer. I'm lending money to the buyer, so I'm best interest for the client, and that's why I like to work with buyer's agents. So that's my input on that. Look, let's go to the next question.
Jason, if I might just quickly add to that, a selling agent works for both parties. A buyer's agent works for just the buyer. And we don't, and I certainly don't, align myself with selling agents. Some buyer's agents do. I find that for me to be able to negotiate as best I can, I need to be as neutral as I can in the space of selling agents. So I have a very civilized, cordial relationship with agents. They know who I am. Obviously, that gives me access to property, although in this market, that's not a great advantage at all, because their one objective is to sell that house at the highest price they can. And my one objective is to buy it at the lowest price I can. So we don't have alignment in that space.
Yeah, excellent. Thank you. So the next question, what impact do you foresee coming from the changes to expat tax regulations slated to be implemented in July this year? What are your thoughts, Jo?
Yeah, so that's an interesting one. And I'm assuming this relates to how many days spent in Australia, whereas previously we had 180. And now the discussion's sitting around 45. Look, I think it's a disincentive. There is no doubt about that for us to be here. But at the same time, I think that in property, in regards, so that's a bigger question than my space, and I'm certainly not a tax agent. But in regards to property, there were major changes in tax laws around expats and Australian property ownership. And those changes came into place several years ago, and they related to how capital gains is dealt with as a non-resident. They related to the tax brackets that non-residents sit in with all earnings on property. And they also related to the 6-year grace that we got, which residents get, which relates to you can rent your home for 6 years, move into it, live in it for a year, rent it again for another 6 years, live in it for a year and sell it and not be subject to capital gains. So while you're outside of Australia, you're not afforded that same benefit. Now, I'm not a tax expert, but I think these tax changes that happened in that period of time were far more significant when it relates to property. In terms of just the general view, I think there's some lobbying going on where we're trying to get to 90 days, but it is definitely disincentivizing, and we're seeing it, right? Australians are packing up and leaving and going back to Australia and going to places like Singapore for these reasons. So watch this space.
Thank you, Jo. So I'll ask this question anyway. I don't think we can answer it. There's another similar tax question. Is a website bank valuation for Hong Kong property acceptable to the ATO? For me, I'm not sure. And Jo, do you know the answer to this?
It's not. You would need to have actually a valuation appraisal. So I do both. I do, and I use it on the same principles as a licensed real estate agent. I use it based on historical sales and comparable recent sales. And then I put the fundamentals of land, accommodation and such. And then I also do rent appraisals also. So if anyone is in the situation where they need an appraisal, I can certainly provide that.
To clarify, Jo, was that for Hong Kong or
Australia?
Okay, so the question was pertaining to Hong Kong property, I believe.
Oh, I can't speak.
Do you know the answer to that?
Yeah. No, sorry.
Okay. Yeah, we had a webinar previously with Tommy Ip, so I can always connect you to Tommy, but I'm not aware of that either. You can always give it a try. So what qualification does a BA have? And I'll add to that as well. And what responsibilities do you have? So what qualifications and what responsibilities?
Yeah, okay, so that's a really good one. So in the past, you could do a real estate license and the next day you could open up an agency and call yourself a real estate agent. In March of 2020, that all changed. So the Department of Fair Trading, and I'm going to speak specifically about New South Wales, although I'm licensed in all the states on reciprocal mutual recognition. But in New South Wales, they led this space. The change was that they wanted to bring regulation into the industry and they wanted to have a robust education process and experiential structure. So now you need to do, as a buyer's agent, you need to have a full real estate license, and that license needs to be either a Class 1 or a Class 2. A Class 1 real estate license means that you can be a principal to a licensed agency. It means that you can run a trust account and that you can have a rent roll, and that you can sell property up to a particular value, and also commercial property to a similar value on the same scale. Now, a Class 2 license means you have to operate for a number of years, that being 5, once you're licensed under a licensee who is a Class 1. I'm a Class 1 licensee, which means I'm a principal license holder, which means I can run a full-scale real estate agency. I'm also a registered auctioneer and a qualified valuer. Outside of those 3 disciplines in the industry, I also hold 2 bachelor's degrees. I have an arts degree, general studies, and I have a degree in social sciences, a little bit like you, Jason, with majors in management and counselling. So customer insights is a really important factor in my qualifications, and all of those qualifications were done as a mature age student. In terms of responsibility, my responsibility as a buyer's agent is to work with my clients to realise their expectations, to work solely with their best interests in mind in a professional and transparent way, and to work with them through the process of acquiring a property for them at the best value that the market provides for us at the time, together with my skill. That's the best way I can describe my responsibility, and all things in between that.
Thank you, Jo. There's still a lot of questions coming through, and I'm conscious of the time. I'm sure you don't mind staying on because there's a lot directed at you. I'm feeling no love, but that's okay. But in the meantime, just for everybody, obviously you can see our details on the screen. Again, this webinar is recorded and will be uploaded as soon as I can work out the tech behind that. If you need to rush off, you'll find the remaining on YouTube, and I'll email that out to everybody. So let's keep going with this momentum. This is probably now area related. So do you have any views on property price growth in further northern Queensland, in particular Mackay and Whitsundays region?
Yeah, so Mackay, unlike Rockhampton, had grown significantly over the last 10 years. And Rockhampton actually went backwards. So if we go back 7 years ago, we saw Mackay really lifting in its property values while Rocky went backwards. And now I actually feel that Mackay, it's had a period of not slowdown, but certainly a period of growth that hasn't kept pace with the Harvey region and Rocky. But I do believe now that the gap between Harvey and Rocky is starting to narrow. I think we will see another spur on for Mackay. The big question for that particular region is going to continually be what happens below there. So as Rocky develops, it's got good airport infrastructure going in, and as I said, transport links, and it's still much more affordable. As we go into Mackay, different kind of dynamic, and if we're paying higher prices, I think what you're going to see is people are going to look to that location for affordability, for the opportunity for work, and there are more infrastructure projects happening below Mackay. So I think tourism, which has been hit in the arm, although coming back on now because of COVID, that's certainly going to have a positive impact. Look, I would say on growth, work towards 5 to 8% in the next 12 months in that region is what you would expect.
Thank you, Jo. So what can a buyer's agent do that I can't do?
Wow. Okay. So it's not what I can do. It's not what I can do that you can't do. It's more what I know that you don't know. And as an aspect of that, how I can have your back and make sure that what you don't know, I do know. So as a team, we become formidable, and I'm your eyes and ears in the property space. Look, when I go back to when I first started dabbling in real estate investment, I was 19 years of age, and I had an appetite to put money into something. I had a desire to not go through life having to work for wages for the rest of my life. and I needed to make sure that I was really scared about making poor decisions. So I spent pretty close to 2 years before I put a toe in the water and bought my first property. And in that 2 years, with what I put myself through in terms of learning, I reckon I should have probably done my real estate license after that. Now, if you've got that sort of time to put into a project, good for you, but not too many people do. So I will save you time, which allows you to just get on with what you need to focus on: family, work, living your best life, whatever that might be. I'll also make sure you don't invest badly. So I'm very fortunate that I can stand here in front of you and say every one of my clients has bought a property that has made money, that has got maximum yield for the area, and that has been, if it's an investment property, it hasn't been vacant. And if it's a home they've bought to live in, they've made substantial increase in value over the period of time that they've owned it. I've got no failures. That's what I can do for you.
Thank you, Joe. And like, I think I second that sentiment in terms of all the professionals like yourself and all the other ones I've put together in this series is, what do they know that our normal, everyday client doesn't know? It's accessing that expertise, that experience, the tricks of the trade. Even just for myself, most people have one chance to retire, and I've been fortunate enough to work with hundreds, if not thousands, of clients through different points of their journey. So although I haven't retired, I've definitely helped a lot of people through it. So it's picking up the knowledge from the experts around. Still a few more coming through. And again, if you need to leave and drop off, that we won't be hurt by it, but you'll find it on YouTube. So we'll keep going. And a few people are asking about these areas. Any views on WA, South Australia, and do you operate in those areas?
Yes, I do. I've purchased a lot of property in the last 2 years in Adelaide and regional South Australia. I think if I were to compare WA and SA, I would say that South Australia is a more consistent, firm and solid investment. WA has had, it's a boom or bust town. And as a consequence to that, we've seen great spikes in growth in WA, and then we've seen very big troughs where they've sat in idle and going backwards for as much as 15 years. If you're looking to buy property in WA to move to because it's a lifestyle choice, I think you can buy nice property at a great price, and then that becomes your home. That has to be the driving force. If you're looking to invest in WA, you need to be very savvy with where you invest and how much you spend. And it's like these other regional areas that I encourage people to look at. I put limits on things. In some areas, I say don't spend more than 500,000. We need to make sure that there's a rental demand. And in WA at the moment, there certainly is a rental demand. There are pockets where people just can't get enough rentals and they are bidding on rentals. But I think consistently and over time, if you were to say to me, hand on heart, should I invest in WA or South Australia? I would say South Australia over WA. But if it comes down to just dollars that you've got to spend and you want to put your toe in the water, we can certainly find property in WA that won't be bad investment, but South Australia is definitely a better one.
Thank you, Joe. So again, mindful of time, and I'll end it on this pretty philosophical question. So Joe, what is the greatest learning you've learnt in your time as a buyer's agent?
Yeah, I guess the greatest lesson I've learned is that I don't know it all, and that no one market is the same. And every time we see an increase in market or we see a boom like we are seeing now, the dynamics are very different from the one before. A lot of people will talk about understanding markets based on history, and it is certainly important to know the history. But don't assume you know everything. And every day I wake up and get into my work, it's a day for learning for me. I think that's the most important thing. I was a cocky early investor. And in those early days, I would say, being a cocky, overconfident, early 20-year-old, I made a couple of mistakes, but I held those properties for a long time, so they corrected. But thinking I knew it all was my biggest issue. So yeah, I don't know everything. It's the big one.
Thank you. It's good to be self-aware, right? Look, thank you so much, Joe, and thank you for spending your time with everybody. And everybody, thank you for giving up your time to join us today. We'll wrap it up there. As I said, I'll be sharing this webinar with everybody once it's uploaded on YouTube. If we've missed any question, our details are online on the screen there, so feel free to reach out to us. We've got two more or three more sessions coming up. So the next one being with OFX, which will be going through foreign exchange and the 101s of what you need to be aware of. That followed by that would be all presented by me in terms of how does the private banker look at your financial situation and your journey. And then we'll wrap it up with another tax update for everybody. If you haven't already, follow JL Finance on whether it's LinkedIn, Facebook, Instagram, to keep abreast of the upcoming information and any updates regarding property and any Australian finance related matters. Again, Joe, thank you so much for your time. And for now, goodbye, everybody.
Thanks very much, Jason. Good night, everyone.